Hello, welcome listeners and market participants, and welcome to KBRA's European Credit Podcast, Conversations in European Credit. I'm Gordon Kerr, Head of European Research at KBRA, and today I'm joined by my colleague, Kali Sirugudi from our European RMBS team.
Hello.
And Ed DeVito from our RMBS team in the US here at KBRA.
Hi, Gordon.
Thank you very much for joining me, guys. Today, we will be covering the topic of the later life lending market, where KBRA have been active in rating transactions as well as analyzing the market. The particular focus of our discussion surrounds a recently published report that explores the expansion of later life lending in the UK and the US and its growth potential in other markets. Aging populations have resulted in an increasing number of retirees with meaningful value in their homes, turning to equity release mortgages for a variety of purposes, including leveraging the product to age in place. KBRA has received an increasing number of inquiries about ratings for securitization transactions containing equity release mortgage collateral from both originators and investors, and KBRA expects the issuance of these types of RMBS to continue rising in the UK and potentially expand within Europe. KBRA already has a rating methodology for this type of lending that was first published back in 2018 and has been used in a number of ratings both in the US and the UK. So let's dig into this a little deeper. First of all, let's go back to the basics. Ed, what is a reverse mortgage or equity release mortgage, and what types of customers actually find them useful?
Thanks, Gordon. A reverse mortgage or an equity release mortgage, with reverse mortgage being the term that we use here in the US, is a loan that's secured by one's primary residence, just like a typical mortgage. Unlike a traditional or quote-unquote forward mortgage, however, no principal or interest payments are due until the maturity of the loan. However, interest amounts are added to the loan balance each month, causing the loan balance to grow or negatively amortize. And as I think most listeners know, a traditional mortgage behaves in the opposite way, requiring a monthly payment where the balance positively amortizes or reduces the loan balance over time. And as you mentioned, reverse mortgages tend to appeal to homeowners who are on a fixed income and who can benefit from a supplemental income beyond their savings or pension or government benefits. A reverse mortgage provides such an income stream without the need to service the outstanding debt on the mortgage until maturity. And I should note that while I've used the term maturity, a reverse mortgage more specifically is due upon what the industry calls a repayment event. And this is typically the earliest to occur of the death of the last surviving occupant in the case of co-borrowers, failure to occupy the home on an ongoing basis by at least one signatory on the loan, or the incurrence of some type of default under the loan agreement, such as a failure to keep the home in good repair or to make any required tax payments, although tax payments are really more of an issue in the US. What this all adds up to is that absent some relatively rare events, the reverse mortgage borrower can generally expect a monthly income for life so long as they occupy the home. And for this reason, reverse mortgages are also sometimes referred to as lifetime mortgages in the UK. Now, one might ask, what happens if the balance on the reverse mortgage negatively amortizes to an amount that's greater than what the home is worth at the time of the repayment event? Is this deficit the borrower's responsibility? And the answer, which is part of the case for considering a reverse mortgage, is no. Usually in that case, the loss is borne by the lender, or in the case of loans that are contributed to securitization, such as those rated by KBRA, the certificate holders bear this loss depending on their position in the capital structure. The fact that the borrower is not required to come out of pocket for any loan balance amount above the property value is why UK and European reverse mortgages are sometimes referred to as having a no negative equity guarantee. In the US, it works the same way for private uninsured reverse mortgages. However, there is a large segment of the market in the US where loans are guaranteed by the FHA. These are called home equity conversion mortgages, or so-called HECM loans, and the FHA insurance covers an amount similar to the negative equity amount that would otherwise be borne by the lender. So that's a summary.
Thank you very much. That's a good summary of the product. So in Europe and in the UK specifically, Kali, who are the typical issuers of equity release mortgages?
So pre-GFC, there were 5 UK securitizations issued under the equity release funding shelf between 2001 and 2005. Issuance has since dried up after the GFC, followed by a recently renewed interest in the product as lending volumes have grown. In 2022, for example, there was a record amount of ERM lending in the UK, about 6.4 billion pounds sterling, driven by a supportive macro environment, a steady increase in the population of older home owners, a rising house price environment, and a changing borrower attitude. And the use of securitization of ERMs appeals to both issuers and investors. And in the UK, collateral originated by More to Life, Legal and General, and legacy UK asset resolution originators has been securitized in KBRA rated transactions. The Tout Point Mortgage Funding 2021 Hastings 1 transaction, the ERM Funding PLC Series 2021-1. Now, there are currently 14 UK equity release mortgage originators who are members of the UK Equity Release Council. The prominent ones are Just, More to Life, Pure, and Legal and General. As the volumes of originations pick up, these lenders would be expected to access the capital markets through securitization.
Yeah, it's a slightly different landscape in the US. The reverse mortgage originators tend to be non-bank specialty finance companies. Insurance companies, surprisingly, are not large reverse mortgage originators in the US, even though there are reasons why the product is a good fit for insurance companies, and we'll talk about that a little bit later. KBRA currently has 18 outstanding ratings on transactions issued by Finance of America Reverse, far and away the biggest securitizer and among the largest, if not the largest originator here in the US. Their leading position was bolstered recently when they acquired American Advisors Group, also known as AAG, in the first quarter of 2023, which was probably their largest competitor. And that acquisition is consistent with an ongoing trend of consolidation and some M&A activity in the sector. Another large reverse mortgage originator, Longbridge Financial, was acquired by Ellington Financial in the third quarter of 2022. From KBRA's perspective, after these few larger players, the securitization activity in the private, unguaranteed reverse mortgage sector, and I'll just pause and mention we don't currently rate HECM loans that I mentioned earlier. Most of the securitization activity has been in the form of aggregators purchasing new originations from some of the smaller reverse mortgage originators and or opportunistic purchases of seasoned portfolios or called portfolios.
Thanks, Ed. Coming back to you, Kali, then who are the typical investors in equity release mortgages in the UK and Europe?
So the typical investors in ERM transactions in UK and Europe are insurance companies. And we've also seen some banks, and these banks who may have invested in ERM portfolios, they may be portfolios originated pre-GFC, or these banks may have provided lines of credit to ERM lenders for new originations. So some of these banks have clearly shown interest in investing in securitized paper backed by ERMs. Now, KBRA has observed that UK ERM transactions are increasingly being structured to be consistent with Solvency II's matching adjustment provisions, which give insurers relief for holding long-term assets that match the cash flow of existing insurance obligations.
Thank you, Kali. Ed, turning it back to you in your direction, who are the typical investors you will find in the US? Are they any different?
Yeah, it's again a bit of a different story. And until relatively recently, regional and community banks here in the US have been significant investors in reverse mortgage securitizations, and they've been attracted by the higher yields on the product, but something still tethered to a relatively stable asset, that is to say, a mortgage on an owner-occupied residential property. However, some of the stress in the regional bank sector here, combined with the need for cash flowing assets, has given rise to a greater proportion of institutional investors and insurance companies entering the space. And certainly the conventional wisdom is that the duration and life expectancy linked nature of reverse mortgages make them a natural fit for insurance companies. It's also interesting to note, in a bit of crossover between Kali's world and mine, that we do see increasing interest in U.S. reverse mortgages from European investors. And my understanding is the supply of reverse mortgages is constrained by the volume of originations in Europe and the UK. And so investor demand remains high. And as the product is otherwise a good fit, European investors are increasingly looking to the US for product.
Great. So let's take this another step. Can you guys both really provide us a summary of KBRA's equity release methodology and any sort of key credit considerations that might be relevant to individuals listening?
Sure. We could probably spend an entire discussion on that. And I would encourage anyone interested in KBRA's approach to take a look at our reverse mortgage methodology on our website. We also have a number of publications in addition to the one Gordon mentioned at the top related to the product that might be of interest. But to summarize very succinctly, we look at the timing of cash flows into the transaction, and these are driven by mortality, move to care as people age and have to leave their homes, and voluntary prepayment. And of these, voluntary prepayments tend to be the most impactful and are not bound by well understood bands the way the actuarial drivers like mortality of repayment are. So that's where we spend a lot of time. Upon liquidation of the property, we assume that the property sale occurs in a home price decline environment that generally matches the magnitude used in our traditional forward mortgage methodologies in the relevant countries and jurisdictions where we rate mortgage transactions. And then depending on the reason the loan has entered liquidation, we apply various liquidation lags, timing lags, and or additional disposition or legal fees, depending on, again, why the loan is repaying. And then finally, of course, these collateral cash flows are tested against the transaction structure. And this can involve a number of considerations, including whether the transaction has timely or ultimate principal and interest requirements, matching adjustment structure seen in the UK being an example of some of the former. Another consideration is whether future draws are allowable on the reverse mortgage loans and the means by which these draws are funded. So that's a very high level of our approach, and I think it applies generally across both the US and Europe.
Great. So I guess a question that many people may have in their minds is how these transactions have actually been performing. Kali, do you have any sort of comments in terms of the way that they've been performing in the UK and Europe?
Certainly. So the KBRA rated UK ERM transactions have generally performed within expectations. Cumulative losses on the portfolio tend to be very low to non-existent. And credit enhancement on the issuance structure side have remained relatively stable or grown over time. For the structures which have a scheduled amortization of the notes, matching adjustment as was being discussed by my colleague Ed, there are certain exceptions where the senior notes with the scheduled amortization may show a slight decline in credit enhancement. And that's because the junior notes are not restricted in terms of a specific schedule to the amortization expected. And that's the reason why you would see a slight anomaly in some of the senior notes where matching adjustment structures are involved. Now, the voluntary and involuntary repayment rates for the equity release transactions in the UK are certainly important to consider the repayment and pay down of notes. And that for the ERM 2021-1 transaction have averaged 8.5% CPR, and the involuntary repayment rate is about 0.75%. For the Toad Point mortgage funding 2021-Hastings transaction has experienced an all-in average repayment rate of 9.6% CPR since closing. An additional point to be made is related to the house prices, because house prices affect the leverage of each of these loans. And as seen since the peak of house prices in September 2022, these have fallen or declined by about 5%. And this will mean the loan to value of the ERM portfolios will be slightly higher. However, this is mitigated by the low LTVs, which we have for each of these portfolios, which we have rated in the UK transactions.
Great. And Ed, how have the US reverse mortgage securitizations performed?
Quite well. With very rare exceptions, KBRA has only ever affirmed or upgraded ratings on any classes of reverse mortgage notes in the U.S. over the past 5 years that we've been rating transactions. In terms of specific performance metrics, I'm generalizing a bit, but the vast majority of property liquidations to date have not resulted in any loss. In other words, that negative equity situation I alluded to earlier has not occurred. This speaks to the fact that the originators have been adept in originating loans at LTVs that are low enough such that over the expected life of the loan, which, as we discussed earlier, is highly linked to the expected life of the borrower, it does not allow that loan balance to accrue beyond the property value. And of course, this is helped by what's been a prolonged period of home price increases in the U.S. In terms of prepayment rates, because reverse mortgages don't have required payments, we generally don't think of them as being interest rate sensitive the way traditional mortgages are. That said, the persistently low interest rate environment in the US and everywhere through 2022, combined with increasing house prices, did create the ability for reverse mortgage borrowers to refinance and obtain meaningful additional proceeds, which was an incentive to refinance. And that resulted in a period of time where we did see prepayment levels elevated for quite a period of time. That has since settled down more recently.
Thank you very much, both. While fundamentally linked to residential real estate risk, the analysis of equity release mortgages or reverse mortgages on a loan and securitization level requires analytical considerations that can differ significantly from traditional mortgages. Although certain aspects of the analysis are similar across the two RMBS subsectors, such as property valuation, the analysis of the borrower is driven by actuarial probabilities in the case of equity release or reverse mortgages, as opposed to the ability to repay metrics in the case of traditional mortgages. KBRA has been active in delving into both of these types of analysis and views the increasing pool of older adults who may be seeking additional sources of income in later life, coupled with the attractiveness of the product and its attributes to potential investors, indicates that this is a sector that is poised for further growth in the future. You can find greater detail in our recently published report on our website, and as highlighted by Ed in other publications such as the methodology and other research pieces. Make sure that you are registered to receive our latest commentaries and have subscribed to our podcast, and of course are engaged with our experienced analysts. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Best of luck to you all out there as you navigate through the challenges ahead.